So once again, good evening to all of you. So in this subject, that is international finance. Okay, so we are studying the third chapter, that is the transaction on the international foreign exchange market. So in this chapter, we understand what are the different types of transactions at the international levels across the borders. Okay, so from our last sessions, we understand what is the bond and different types of bond. Okay, so that we are going to understand. We already know that bond is the type of the loan instrument. Okay, so in bonds, it is a loan itself, but it is, we can say, it is a standardized loan. Okay. On bond instrument, we can say a bond represent the loan where the issuer borrow money from investors. Okay, that means he issue that instrument, the piece of paper. In that bond, he write down all the conditions. That is the what is the face value of the bond, what is the discount value, what is the, we can say, the interest rate, that is we called as the coupon. Okay, so all these things, we can say, the maturity date. Okay, so all these things are written in the bonds clearly. Okay, so bond represents the loan where the issuer borrow the money from the investors and promises to pay a specific interest, that is the coupons plus the return at the principal. Okay, what is the face value or what is the principal amount? That means whenever a company raise the funds, okay, so they have to pay the interest rates, that is the coupon rate, and at the maturity of the bonds, they have to pay the face value or the principal amount, lump sum amount from where he taken the loan. So this is the concept behind the bond. Okay, so bond, we can say, very significantly by the coupon structure, maturity period. Okay, so what are the key variables in the bond? Okay, so what is written in that piece of paper on that bond? That is, we can say, the face value, coupon structure, or we can say the coupon rate. Next one is, we can say, the maturity period, maturity date. Okay, or we can say the issuer's credit worthiness and the special features. So all these are these some of the features of a bond. Okay, so what is the purpose of the investment? Why investor invest in a bond? Because the investor utilize the bond, we can say, strategically for this steady income generations. We know that if you as an investor gives loan to any company or any individual investors, okay, on some specific interest rates, that means that who takes the loan pays you the installments, monthly installments, or we can say the quarterly installments, 6 monthly installment, yearly installments. Okay, so that means if you invest in a bond, the investor can generate a, we can say, a steady income with the help of these bond investments. Okay, or we can say he can diversify his portfolio by investing in a bonds. We study all these in the subject, that is the in security analysis and portfolio management. That is how the investor makes the good portfolio by analyzing the risk and return. Okay, for this, by analyzing all these things, in the morning we study two model, that is the Markowitz model and CAPM model. Okay, so whenever we as an investor, we think that the bonds gives me a good return with the minimum risk. Okay, so this is the good options for the investment purpose. Okay, so here in the last sessions, we see the some of the types of bond, that is the foreign bonds and the euro bonds. Okay, when the one country issues the bond in the another country, that type of bond we called as the foreign bond. That means if the American company, we can say the Tata or Reliance, when he issue the bonds in any foreign country in their native currency, such a type of bond, whenever the Indian company raise the loan in the foreign country with the same currency, such a type of bond we called as the foreign bond. For example, if the Indian any company, we can say the Reliance, issued the bond in Japan in yen, or in US in a dollar, in Australia in Australian dollar, in we can say the England in we can say in a pound. So all these such a type of bond we called as a foreign bond. Okay, so what is the basic difference between the foreign bond and the euro bond? So euro bond is nothing to do with the euro, or we can say the euro currency. So don't we can say confuse between the don't link that euro currency with the euro bond. Okay, so why we called this type of bond is a euro bond? Basically the beginning of this such a type of bond was we can say was happened in the Europe. So that's why we called this such a type of bond is a euro top. What is the euro bond? When, for example, when the any particular country issue a bond in a foreign country, but not in their native currency, such a type of bond we called as the euro bond. For example, when Indian company, we can say the Reliance wants a Japanese yen. Okay, so Reliance want to expand want to expand their business in Japan. So for that purpose, when they want the funds, when but to raise a fund, Reliance issue a bond in US, in the United States, and they raise a Japanese yen in the US market. So such a type of bond we called as the Euro bond. So these two types of bond we already see in the last sessions. Okay, so this is the basic difference between the foreign bonds and Euro bond. Okay, Euro bond is also a foreign bond, but they are not issued in the native currency of that particular country. They issue in always in a different country. For example, if the Europe, we can say the US company Apple wants to raise the Australian dollar in Indian market, and they issue the bond in the Indian market to raise the Australian dollar. So such a type of bond we called as the Euro bond. Okay, so this is the example. So likewise, there are also some another examples or another types of the bonds, so that we are going to understand in these sessions. So there are the two basic we can say on basis of the rate. Okay, on the basis of the coupon rate or the interest rates, we can divide the bonds into the two types, and that is the fixed rate bonds and the floating rate notes. Okay, so what is the meaning of these two types? Okay, so fixed rate bonds are the types of bond. Okay, so they are issued at the fixed interest rate or the fixed coupon rate. Okay, that means so at the beginning of the bond, the company and the we can say the investor who gives the loan to the particular company, they mutually decides the interest rates or the coupon rate, and that is fixed till the maturity date. Okay, so we can say there is a no change in the interest rates in between the any in between the period till the maturity date, so that rate is fixed. So such a type of bond we call as the fixed rate bond. And another one is we can say the floating rate notes. So floating rate notes, that means in such a type of bond, the interest rates or the coupon rate is a variable. Okay, that is we can say it is a floating interest rates. Okay, so the floating interest rate is mutually decided by the investor and the company or the organizations who takes the loan. Okay, so that floating interest rates is actually linked with the labor rate. Labor means we can say the mm, labor is a rate which is announced internationally in a London-based rate. Okay, so LIBOR is we can say the London Interbank Offer Rate was a key benchmark for the short-term interest rates used globally in the financial market, and it was calculated based on the estimated sum submitted by the leading banks in London. Okay, so that means we can say this rate is announced by the leading banks in London on for the international level. So that bond is linked with such a type of rate. And okay, so whenever the coupon payment made by the companies, okay, so they'll make the coupon payment on the basis of that labor rate. Okay, so that is the floating exchange rate. Okay, so we can say the investors had an advantage if the value of the labor rate gets increased. Okay, so this is how the floating rate notes we can say works. Okay, so if you see that is the coupon formula structure. That is how the exchange rate decided for the floating rate notes. That is, if you see the floating rate notes, coupons typically follow the formula. If you see in the point number one, that is the coupon formula structure. That is the reference rate. Rate means that is the labor rate plus spread. Okay, spread is actually we can say is a type of the we can say the difference between the highest value of interest rate and the lowest value of interest rate. So this is how the floating rate is decided. Okay, so labor plus 1.2 here we take as the floating rate. Okay, so that floating rate coupon that exists quarterly based on the prevailing market conditions. Okay, next one is the dynamic rate adjustment. Okay, so we know that in a floating rate notes, the interest rates or the coupon rate is not fixed. It is always a volatile. That is means it may go up or it may go down. Okay, so when we can say it is the dynamic rate adjustment. Okay, that means the rate is continuously existed. Okay, when the reference rate rises from 1.3 to 2.0, the total coupon payment increases from 2.5 to 2.7. We already know that when if the labor, that is the London interbank offer rate increases, okay, so we plus 1.2 in that. Okay, so when we see that labor is 1.3, then we add 1.2, so the final coupon rate is 2.5. Okay, so this is how we adjust the coupon rate or the interest rate. Next one is we can say the payment frequency. So most of the floating rate notes coupons they make the payment on a quarterly basis or a semi-annual basis, allowing for the regular rates receipts that keeps the pace with that. Means at the every payment, at the every coupon payment, every installments, first they adjust the coupon rate according to the market conditions, according to the labor rate, what London Interbank they offer a rate. And on that basis first they fix, we can say, first they calculate the coupon rate, and then the companies make the quarterly or the semi annually. That means once in 3 months or the once in 6 months they make the payments for the bonds they issued. Next one is we can say the issuer application. The banks, corporations, financial institutions frequently issue the floating rate notes to manage their own while providing the investors with the inflation's protected income streams. Okay. So if you see if you see in the diagram given here, that this diagram is shows the coupon payment made by the companies. If you see at the starting in the starting year, when the coupon rate is low, the payment made by the companies are lower. Okay, but as we know, when the labor rate or the floating rate goes up in the upcoming years, the coupon payment made by the company is the, if you see the slope of the graph is the upward sloping. Okay, so this illustration demonstrates how floating rate notes coupon payment rises and fall in a tandem. If you see, sometimes it goes up. Okay, so and followed by the we can say the lower coupon payment. So this is how the floating rate payment. If you put all these data into the graphical form, so this is how we get the graph. Okay, we already know that the floating rate note coupon payments rise and fall in tandem with the underlying labor benchmark rate. Okay, what is meant by labor? I already told you that some of the banks are the well-established banks in the London. So they issues the London interbank offer rate for the international market. Okay, so this is how we can say the floating rate notes works. So next one is we can say the deep discount bond. So what are they? Okay, so what is mean by the deep discount bond? Whenever the any government or the any company, multinational corporations, whenever they wants the fund uh, very seriously, that means the funds requirement is we can say is much needed to them. So in such a condition, what happened, they issue a bonds into the market at the we can say we can say at a very uh, much discount. Okay, that means the face value of the bond is we can say the 100 rupees. Then the company issues the bond in the market is for only 70 rupees. That means you have to pay the 70 rupees to purchase the bond, and at the maturity of the bond, the investor gets the 100 rupees. So that is called we called as when we can say the below par issuance. That means the bond is issued by the companies at we can say a below par. Okay, that means they gives a very much discount in their bonds. That means the deep discount bonds are issued at prices significantly below their face value, typically 20 to 40% below par. That means if the face value is the 100 rupees, then they issued at the 20 to 40% discount. That means at the 60 rupees or the 70 rupees or 80 rupees, if they issued such a type of if the company gives such a type of discount 20 to 40 rupees, then such a type of bond we called as the deep discount bond. And why companies gives this huge discount? Because they want to sell their bonds into the market. Okay, so there is we can say there is a we can say a much necessity of the funds to the companies, to the organizations, and that's why they use that much discount to the investors. So they attract the investors because the investors see the highest return, he see the much discount. He thinks that I'll have to give 60 rupees, and at the maturity I'll get the 100 rupees. Okay, so for the discount, investor attracts towards the bond, and company is able to sell that bond in the market as quickly as, because they want the fund because their we can say the fund requirement is we can say a very much fund requirements in the company, in the organizations, and that's why they issue the deep discount bond. Okay, so minimal coupon structure. So these deep discount bond instruments pay a little to no periodic interest during their lifetime. Okay, so in deep discount bond there is a no coupon payment uh, are made by the companies in between the maturity period issue in the issuing or the at a maturity period. Okay, only the face value or the par value will be paid by the companies to the investors at the end of the at the maturity. Okay, so next one is we can say the capital appreciation return. The investors returns derive primarily from the difference between the discounted purchase price and the full pair value redemption at the maturity. Okay, that means the deep discount bond gives the capital appreciations within a short period of time. That means if I purchase the 60 rupees bond, then within a some time, okay, at the end of maturity, my 60 rupees will be 100 rupees. Okay, so capital appreciations will be very quickly in such a type of bond. Okay, so issuer benefits, the governments and the corporations utilize this structure to raise the capital while minimizing the immediate cash flows. Okay, whenever the companies or the government wants a quick cash, okay, or the immediate cash to fulfill their funds requirement, then the government or the big corporate houses issues such a type of bond, that is the deep discount bond. Okay, so what is mean by, now we understand the floating rate notes, that is the floating rate bonds and the deep discount bond. Now, what is mean by that zero coupon bond? So zero coupon bond, okay, now in the name itself, if you understand that zero coupon, that means once you purchase such a type of bond, okay, you will not receive any coupon in between till the maturity period. That means once you purchase the bond, okay, you will get the return at the maturity date, at the end of the maturity. That means no payment in between the times till the maturity date. So such a type of bond we called as the zero coupon bond. No periodic interest payment in such a type of bond. That means once you purchase the bond, okay, you will receive your return at the end, at the maturity date. Okay, so no periodic interest payment in such a type of bond. The zero coupon bonds pays the absolute no interest during their lifetime, offered okay, so the we can say the coupon percentage in such a type of bond is already given in the name of the bond, that is the zero coupon. Okay, that is the zero coupon rate that eliminates all the interim cash flows to the investors. Okay, next one we can say the deep discount pricing. So these bond sales at this substantial discount to face value are redeemed at the full par value upon the maturity. Okay, sometimes the zero coupon bonds, we can say, when they issue at the we can say larger discount, then such a type of zero coupon bond we also called as the deep discount bond. Okay, so zero coupon bond may be a deep discount bond if the company is issued at the, we can say, a large discount. Okay, next one is, we can say, the return calculation example. If here is one example is given. Okay, so uh, see the example carefully. That is a 10-year zero coupon bond issued at 74.51% of the face value, provided approximately 3% annual compound return through the price appreciation alone. Okay, that means the 10-year zero coupon bond issued at the 74.51% of the face value. That means if the face value of the bond is 100 rupees, that you can buy or purchase that bond at only a price of 74.51 rupees. Also, okay, so at the end of the maturity, you will get that 100% plus 3% annual compound return. Okay, so this is how we calculate the return in the zero coupon bond. Next one is the long term planning tool. Okay, so whenever the investor want to invest for the long term purposes, he don't want we can say the continuous emis or the continuous payments for the his investment, then it is, we can say, a long term planning tool. Zero coupon bond is nothing but a long term planning tool, because we know that in between the period till the maturity date, no coupon payment, okay, no installments we will receive in between the times. Okay, so the zero coupon bond excel for the specific future obligations like the college tuitions, retirement lump sum. Okay, we know that the parents made the investment for some of their goals or the objectives. Okay, the parents already know that how much children they have. Okay, what the educations they will provide for their kids. So for these purposes, the proper planning made by the parents. Okay, to fulfill the financial obligations that is the college tuition fees. Okay, so also the parents require the lump sum amount for their retirement. Okay, or any other predetermined financial goals with the known timing. Okay, so if I know that after 10 years I require that much amount, so I can purchase the zero coupon bond of the maturity of the 10 years. So after 10 years I will receive that lump sum amount, so I can achieve my objective or goals. So this is how the zero coupon bond works. Okay, so the zero coupon bonds, we can say, we see from the investors point of view, that zero coupon bond is, we can say, a price volatility risk. We know that in zero coupon bonds, we can say the default risk is more, because the no payment is get in between the time, but the payment you receive, or your all your return you receive at the maturity date. Okay, so that's why we can see some of the risks, that is the zero coupon bond exhibits significantly the higher price sensitivity to interest rates changes compared to the coupon payment bonds, creating the both opportunity and the risk for the investors. Okay, so next one is the one more advantage is the no reinvestment risk. That means you will not receive the amount in between the periods, so there is no tension of the reinvestments of that amount. Okay, so since the no coupons are paid, that means the investor not going to receive the any we can say payment in between the time. So the investor face the zero reinvestment risk, guaranteeing the compound return if held to maturity regardless of the future interest rates changes. Okay, so this is how we can say the zero coupon bond works. Now next type of bond is called as the dual currency bond. Okay, when we can say the dual currency bond introduce sophisticated currency exposure by dominating the principal and coupon payment in two different currencies and creating the unique risk return profile for the international investor. That means, for example, if the US, any US company issue a bond in US dollar, and I purchase that bond in rupees, with the exchange rate, and then we have to repay the loan amount in these two currencies, that is in rupees and US. That means whenever the bond actually issued in one currency and the buyer purchase in the another currency, and the with the help of the exchange rate, so all such a type of bond we called as the dual currency bond. That means the bond, the two currencies clearly mentioned, or we can say the financial transactions will be done in the two currencies. So such a type of bond we called as the dual currency bond. So what is the currency? We can say, what is the structure of the dual currency bond? A typical structure might pay a quarterly coupon in US dollars while repaying the principal amount in euros at maturity. Okay, so creating that type of bond we called as the dual currency bond. So so the application of the dual currency bond is, we can say, the multinational application. The multinational corporations, companies, and internationally focused investor are used this instrument to naturally hedge the currency exposure across the global operations and the portfolio. Okay, so this is how a dual currency bond works. Okay, so next type of bond we called as the equity related bond. That means you can buy such a type of bonds from the companies that after the maturity of the bond, you will not receive any face value. Your face value, on behalf of the face value, you will receive the number of shares or the equity of that particular company. So this is what we call as the equity related bond. That means your we can say the principal amount or the face value is linked with the number of shares or the equity of that company. So that's such a type of bond we called as the equity related bonds, or the, we can say, the hybrid instrument. That means for example, if I take, if there is any, we can say, the startup. Okay, so if the startup requires the loan amount of the, we can say, the 10 lakh rupees, so I gave the 10 lakh rupees loan to the to that startup. with the condition that if the condition that and they if we can say the startup is we can say is fail, then I'll receive all my loan amount back because it's a loan. Okay, so I'll receive all the interest or the coupon, okay, all the principal amount. But what condition I put in that bond, if the companies we can say will be successful, then at the maturity of that bond, I don't want the face value or the principal amount in my hand, but I want the number of shares of the with that same principal amount or the face value of the organization. So in that case, what happened? Okay, so the investor minimize the risk. Okay, if in the starting, if I share, if I buy the equity shares, then I will be the equal owner of that company or of that we can say the startup. If the startup fails, then I will be in the loss because I buy the ownership by purchasing the equity shares. Then you have to bear now the losses. But in the start, I'll directly not purchase the equity shares. First, I gave the loan with the bonds to that company. Okay, then I see if the company is doing well, then I convert my face value amount into the equity shares. If the startup or the company fails, then I can recover all my amount because it's a bond, it's a loan. Okay, so this is how the equity related bonds, the hybrid instrument that minimize your risk and maximize your return. Okay, we can say what are the features of the equity related bonds, so that we are going to understand that is we can say the fixed income foundation. That means this instrument provides the we can say the stability and income characteristic of the traditional bonds while incorporating the equity linked features for the additional return period, or we can say the growth company application. That means we can say the small startup and the high growth companies frequently utilize this structure to raise the capital while offering the investor both downside protection and the upside participation. That means what is meant by that downside protection? If the company is not doing well, their financials are downsides, then you will receive the protection because it's a bond. Okay, but if the company is doing well financially, their revenue increases and upsides, their profit on upsides, then you can convert your bonds after the maturity into the equity shares. So this is how the investor can take the advantage of the both these situations. Okay, so this is how we can say the equity related bond works. So the equity related bonds has this one feature, that is the conversion features. That the many equity related bonds includes the convertible features that allowing the bondholders to exchange their bonds for the predetermined shares of the common stocks. Okay, so this is how we can convert the bonds into the equity. So the here we see the convertible bonds, that is debt with the equity options, that is the convertible mechanism, that is the bondholders can convert their bonds into the predetermined number of common shares, typically at the conversion price set above the current stock price. That means at the start of the bond they actually decided the price or the number of shares for that principal amount or the face value. Okay, so next one is the lower coupon rate of the issuer pay lower interest rates than the straight bonds because of the investor receives the value from the conversion options. Okay, so such a type of bond the companies can issue at the lower interest rates or the lower coupon rates because they gives we can say the options to the investors that they can convert their bonds into the equity, so they can take the advantage of the valuations wealthy we can say the wealth maximizations of the organizations. So this is how the equity related bond works. Okay, so here if you see is the what is the basic difference between the all such a type of bond. that is the fixed rate bonds, floating rate notes, deep discount bond, zero coupon bond, dual currency bond, and the equity related bond. Okay, first we see the coupon type. Okay, what interest rates offered by the different types of bond. First one is within the fixed rate bond. So in the name itself, we understand that is the coupon rate is fixed in the fixed rate bond. In the floating rate bond, from the name itself, we understand the interest rates in the floating rate node is the floating one. Okay, next one is the deep discount bond. Okay, so in deep discount bond, we already I told you that the coupon rate is, we can say, is the none. That means in deep discount bond, they are providing the we can say a good discount near about 20 to 40%, but they are not going to we can say they are not paying any installments. Okay, they are not going to pay a coupon payment in between the till the maturity date. In zero coupon bond, we can say the coupon type is none. Next one is the dual currency bond, maybe fixed or the floating. It depends upon the two parties who are we can say uh, the company and the investors, they mutually decides the fixed or the floating. Or equity related bond is the fixed in equity related bond, so the coupon rate is fixed, but you can convert your face value into the equity. That means fixed a coupon rate plus equity. Okay, so this is a difference of the different coupon type for the different bond. Next one is the risk level. Now we are going to analyze what is the risk level for these different types of bond. That is the fixed rate bond is, we can say, the risk level is the moderate one. Okay, in floating rate note, the lower interest rate risk, because we know that as per the market conditions, the interest rate goes up or the goes down. So your risk automatically minimize here in the floating rate note. In a deep discount bond, a higher price volatility, because we know that if the company defaults, okay, then there is a high risk associated with the deep discount rate, because we know that there is a no installment we are receiving. Okay, at the end of the maturity, we will receive all the face value. So there is a huge risk of the, we can say, the default risk or the credit risk. So in zero coupon bond is same, that the risk is the high, that is the high volatility. In dual currency bond, the currency is there is the, we can say, the currency exchange risk is always associated with the dual currency bond, because dual currency bond, we can say, deals with the two type of different currencies. Now equity related bond, we can say the risk level is the equity risk component. It depends upon the equity risk components. Next one is the typical use case. Okay, when we use which type of bond, that is when a stable income, when an investor wants a stable income, then he'll invest in a fixed rate bond. Okay, when he wants to protect his investment from the inflation. Okay, so in such a type of, because as per the inflation, as per the market condition, the coupon rate is changed in the floating rate note. So when the inflation protection strategy, the investor wants the protections from the inflation or from the other market conditions, then he'll invest in the floating rate note. Next one is, we can say, the deep discount bond. Okay, so long term capital growth, because we know that we will get the huge return in the deep discount bond, because it issued on a very high discount. In zero coupon bonds, okay, future lump sum requirement, because we know that at the end of maturity, zero coupon. That means no coupon payment in between the time. Okay, what the amount you will receive at the maturity time, at the maturity date. Next one is, we can say, the dual currency bond. So whenever the investor wants to diversify his investments internationally, so in that case he can issue, we can say, buy the dual currency bond. Next one is equity related bond with the growth with the income balance. Okay, whenever the investor wants to take advantage of the growth of the organizations, but he want to uh, minimize the risks of the investment, then he can buy the equity related bond. Okay, that means if the company is doing well, then he can convert his face value principal amount into the equity shares. So that means automatically his wealth increases. Okay, so this is the basic difference between the different types of bond and the according to the different features, that is the coupon, risk level, and the typical use. Okay, so this is all about we can say the different types of bond. Okay, so we will just understand the some of the major risks associated with the bond type, that is the interest rate risk. Okay, so we will know that if when the investor invests in the fixed interest rate, okay, so there is a no interest rate risk in such a type of bond, but in the floating rate note, okay, or we can say in the dual currency note. Okay, in such a type of investment, there is always the interest rate risk. That is the fixed coupon bond face the significant price volatility when the market interest rate change. Okay, with the longer maturity bonds experience the greater sensitivity to rate movements than the shorter term instrument. Next one is we can say the credit risk, or we can say the default risk. If the company is not having the enough funds, enough liquidity, or enough ability to repay your funds, your coupon payments, your face value, principal value, then that is one type, that is the risk. So all bonds carry the possibility of the issuer default, where the borrowers cannot meet the interest or the principal repayment obligations. So it may happen if the company is not having the enough cash with them. Okay, so if they are not in a position to make you the payment, for example, if you take the Kingfisher Airlines, that the people invest with the we can say a large hope in that Kingfisher Airlines. Okay, if the any investor issue, if they buy the bonds of the Kingfisher Airlines, okay, the company itself not having the enough revenue, enough profit, enough cash with them. So how he can make the repayment of the coupon rates and the principal amount? So this is we can say the credit risk. Next one is we can say the currency risk. We always know that if on international level in the dual currency rate, if the investor invests, so the currency exchange rate is one type of risks, or we can say the liquidity risks and the tax considerations. We know that the different tax structure of the different countries different. So this is how we can say the bond, we can say, gives the return to the investor, and these are the different types of bond in which the investors can invest. Okay, so here one small video, so you can further understand how bond works. Okay, so listen carefully.
This video over. Bonds are some of the most necessary and fundamental vehicles in the financial sector. They allow towns, governments, companies, and other groups to get funding. Bonds are essentially just IOUs to the person giving you money, the lender, that says you're going to pay them back sometime in the future. They're a fancy form of a loan that gets companies and governments funding when they need it. What makes bonds different from loans is that they're a form of a security, in that you can buy a bond and start getting payments from the company that owes you. In essence, bonds are securitized loans. Bonds will typically include an end date in their terms when the entire amount of money is due back to the issuer, as well as terms for the interest payments to be made. These are some core principles about bonds to remember if you're looking for a general overview. They're corporate or government debt issued by an organization that are tradable assets in the form of securities. Bonds are stable and referred to as a fixed income instrument. Their payments to holders don't fluctuate over time like the value of stocks or dividend payouts do. Bond prices inversely correlate with interest rates. Since a low interest rate usually means the borrower is trustworthy, more people will want to own that bond because there's little risk. Conversely, high interest rates infer a risky borrower, which increases the chance that a bond will become worthless, thus making them cheaper. Bonds have dates at which point all of their value must be paid back. This is called the maturity date, and beyond this point, the bond ceases to exist. Like we mentioned before, bonds are a way for companies or governments to raise money without giving up ownership of their company, which is what selling stock would do. If a government needed money for a project, they could issue bonds, which investors can buy and be guaranteed payments by the government. Government bonds are typically seen as safe because there's little chance the government won't pay back the funds. Companies, on the other hand, go bankrupt far more often, which would mean any bonds they issued would become worthless. If companies like Apple issued a bond, investors would eat it up because it would be seen as a very safe investment. However, if a company like Blockbuster issued a bond to raise funds to open up a new store, it would be a pretty risky bond. You might be asking yourself, though, why wouldn't a company just go to a bank and get a loan? Well, chances are the bank can't loan them the amount of money they need. In this case, companies have to turn to selling bonds to raise more capital. Bonds provide a way for individual investors and funds to become lenders to massive companies. Think of it almost as a way of crowdfunding corporate or government debt. Finding one bank to give you $20 million might be hard, but
If you want to become a highly successful investor with a wealthy portfolio, never trust
finding 20,000 people to give you $1,000 would be a lot easier. Now that we've covered why bonds exist and who issues them, let's talk about the specifics of how they work. Bonds are a form of security, just like stocks, except bonds are generally more secure and offer payments over time and have an end date, which is how investors make their money, rather than buying the stock at one price and selling it higher later. Bonds can be traded publicly or privately depending upon the way that they're set up. While you might buy a bond in a similar way as a stock, the difference is that bonds will come with terms and a plan for how you're going to get your money back. Bonds will include the terms of the loan, the interest payments to be made over time, and the maturity date, the time at which the entirety of the funds need to be paid back to investors. Bondholders make their money through interest payments the company makes to them, on top of paying back the original loan. Interest payments are called the coupon, and the interest rate is called the coupon rate. Most bonds are usually priced at either $100 or $1,000, called the par value. However, prices can fluctuate as people buy and sell them. If a company issues a bond when their financials look good, but then something like, say, a pandemic happens and the company loses all their revenue sources, the bond would fall in value as people wouldn't want to own it. However, since the bond was already sold to investors, in this case it would be the investors who lose their money, not the company who issued the bond. This is the same way stocks and other securities work. It's the risk of investing. The value of a bond depends on these main factors: credit quality of the issuer, date until maturity, and the coupon rate compared to the average interest rate of other bonds. You could buy a bond and never plan to hold it until maturity. Rather, you could buy a bond to just flip it a few weeks later if the price went up. Conversely, you could also just buy bonds and let them sit, collecting interest over time and making your money back slowly. Let's go through some more specific principles of bonds. Face value is the amount of money the bond is worth at maturity. A face value of 1,000 would mean that at the maturity date, the issuing company would have to pay you back the full $1,000. The coupon rate is the interest rate which the issuer will pay. A 5% rate on a $1,000 face value would mean that you'd get $50 per year in addition to the $1,000 at maturity. Coupon dates are the dates when interest payments will be made. The maturity date is the end date of the bond. And finally, the issue price is the initial price the issuer set to buy the bond from them. The major determinants of quality of a bond are the credit quality of the company or government, like a corporate credit score, and the time to maturity. If the issuer has bad credit, the risk of losing all of the bond's value is greater, making the interest rate be higher in order for investors to be willing to take the risk. If the maturity date is further out, the interest rate will usually be higher too, since it will take a longer time to get back the initial investment. Companies get credit ratings from credit ratings agencies like Moody's and Standards & Poor's. Side note, these companies were also one of the main reasons for the 2008 financial collapse, something we talked about in our video on mortgage-backed securities, linked right here. Bonds that are stable are called investment-grade bonds. These are typically US government bonds and strong, profitable companies. Bonds that are risky are called high-yield bonds, or junk bonds. These bonds have a greater risk of losing all of their value, which means they'll pay out a higher interest rate, but you could lose everything if the company goes bankrupt. Main categories of bonds are corporate bonds, which are bonds from companies, municipal bonds, which are bonds from states or cities, government bonds, which are bonds issued by a national bank or government, and agency bonds, which are issued by organizations that are affiliated with governments. There are also unique bond structures different from what we initially talked about. Those are zero coupon bonds, which are bonds that don't pay interest but are rather sold at a discount and paid out in full at the end of the term. For example, you could buy a $1,000 face value bond for $900 and in 5 years get back the full $1,000. Convertible bonds are another type, which can be converted into stock down the line depending upon the stock price. This allows companies to pay less interest to the bond holders that are willing to get stock of the company down the line instead of a higher interest rate over time. For example, a normal bond might have a 12% interest rate, and a convertible bond might have an 8% interest rate, with the ability to be converted into stock if the stock hits a certain price down the line. It's less payments for the company up front and could be an attractive risk to the bond buyer. There's also callable bonds, which are bonds that a company can buy back if they determine they can get a better interest rate down the line. Say their credit rating improves and interest rates decline. The company could buy back the bond and reissue the bond at a lower rate. Finally, there's puttable bonds. These bonds allow the holders to sell the bond back to the company before maturity, which is a way for investors to protect themselves if they're worried about the company not paying up down the line. Lastly, let's talk about how bonds are priced. Bonds prices fluctuate just like any other security on the market. Just like if a company starts doing really well, their stock price might go up, so might their bond price. If a company starts losing a ton of money, their stock price might go down, so too might their bond price. All of it is a matter of supply and demand, what investors are willing to pay and what somebody's willing to sell it for. In reality, though, there's a variety of technical factors that go into pricing bonds that we won't really delve into in this video. At the end of the day, bonds are just loans to borrowers that individual investors hold, not big banks necessarily. They can be fantastically stable investments that should make up part of your investing portfolio. They can also be radically risky investments that can make or break you. Bonds are at the center of the way our modern economy functions, and understanding how they work is crucial to understanding investing.
So, students, here we finish the third chapter of the subject of the international finance. Okay. If anyone have any doubt, you can ask, or otherwise we will sum up the sessions. Okay, if you don't have any questions, so then you can leave the sessions. Okay, Rohit sir, please end the sessions. Rohit sir, please end the session.